On the surface, there were no surprises. Nobody expected the RBI to change rates today, and consistent with that, the RBI was on hold. But if you dig a little deeper, what you find in the policy statement is that the central bank has become a little bit more cautious about its inflation trajectory over the course of the year. They now expect inflation to be about 5% in the second half of the year, and also worry a little bit about upside risks. I think this is both because the RBI expects growth next year to pick up meaningfully, and therefore they believe that pricing power may increase because input costs have gone up. But also, I think equally because of other external factors, there are worries about an El Nino this year, and so they do worry about what that could do to not just food inflation, but also inflation expectations, because what you find is inflation expectations are impacted disproportionately by salient food items. So if those food prices do go up, they would, like any good central bank, worry about that spreading to inflation expectations. So I would say compared to February, the RBI is a little more confident about global growth, hopeful that India's growth accelerates, but therefore also a little bit worried about inflation risks down the line. That said, at least for now, we expect them to be on hold for the near future. The other interesting part was in liquidity. Now, one thing we've seen post demonetization is the huge gush of deposits with banks, and the fact that interbank liquidity is in a very large surplus. What that's done is essentially distort the short end of the yield curve, where 3-month treasury bills and 12-month treasury bills were much below the policy rate. So it's impeded the RBI's signaling mechanism. And to address that, what the RBI has done is narrowed the corridor. So the reverse repo has now moved up to 6%. I think that's being done to normalize the short end of the yield curve and therefore improve the RBI's signaling mechanism. I think, however, their move on liquidity was quite balanced. They will still use a variety of different instruments to drain liquidity, but I think there was a preference indicated for the standing deposit facility, and they're awaiting government approval on that. So I think the next thing we should expect on liquidity at some point is an STF that the RBI could perhaps use to drain liquidity and therefore better align its liquidity stance with its policy rate stance.